Hello, everybody. My name's Mark von Grunter. I'm a director of Benham and Reeves. It's a very exciting day, but we're going to start in a couple of minutes because people are starting to join, and I just want to make sure as many, because this has been a massive budget and there's lots to talk about. And so I just want to let as many people just join us. So I hope you're going to bear with us for a couple of minutes. We won't start too late, we should be definitely finished within an hour. We are going to try to keep the questions around the budget and how it affects you. I'm always around if you have other questions after the budget or anything to do with property investment and things like that. Feel free to message me, but I'll be back in a couple of minutes. We'll start very soon. Thanks. Hello, everybody. Welcome to the Benham's webinar post-budget. Our post-budget yesterday. It was a very exciting budget. And let me introduce myself. Thank you for waiting a couple of minutes. My name is Mark von Grunter. I'm a director of Benham and Reeves here in London. And this webinar, we are very lucky today to have with us David Smith, who's the economics guru or editor of the Sunday Times. He's been there since 1989, and he writes, if you see the Sunday Times, he writes a weekly column, and he's been doing that for the last 10 years. He's an author of several books, including Free Lunch, Easily Digestible Economics. So that's good for me. Even though I did economics degree, visiting professor at Cardiff University and Nottingham University, and he's won a lot of awards over the years, including Business Journalism of the Award at the London Press Awards and Property Columnist of the Year. And we're so lucky to have him with us. So welcome, David. And David is going to go through and pick out all of the key things that from the budget yesterday and from that's going to affect you and all of our clients. So thank you and welcome, David, and I'll hand over to you. And we're going to answer questions at the end. So if you have any questions, either pop them in the Q&A or you can email us afterwards. Thanks very much.
Thanks very much, Mark, and thanks to Benhams for inviting me to take part in this webinar. It's still hot off the press, as it were, the budget. So plenty to think about. There's been lots of analysis already, and lots to come. So let me take you through a brief presentation, and then we'll take it from there. So I'm hoping. Oh, there they are. There's my slides. That's me, and that's my Twitter or X handle. If you're ever looking at X or Twitter, I still do it. And so I want to take you through the some of the things that we saw yesterday. What was in it? What does it mean for you, particularly in the property sector? So let me just set the context first by trying to answer four questions. I want to talk about the economic and business outlook, both in the UK and globally. I want to look at what Rachel Reeves, the Chancellor, first female Chancellor of the Exchequer, of course, we've had first UK woman finance minister. What's it mean for property? And perhaps more importantly, does it mean that interest rates are going to fall faster? And how far have they got to fall in the UK? And what does that mean, again, for you? So let me take you through this. I'm not going to dwell on any of these things for too long. I want to leave plenty of time for discussion and questions at the end. But let me take it. It's always easier to answer questions you've set yourself. So let me try and answer those four questions quickly. We've had, over recent years, I suppose the backdrop to this budget we saw yesterday was that all these chickens have come home to roost. So we had these, we've had the run of shocks, beginning with the global financial crisis 2008-9. Then we had the Brexit vote in 2016, first Trump term, the pandemic. Everybody on this call would have lived through previous pandemics, but none of which had the same kind of economic and business impact as COVID-19. And then we had the Russian invasion of Ukraine, which gave us higher inflation and higher interest rates. The Russian invasion really was the main cause of us breaking out of this period of near zero interest rates that we'd seen since the financial crisis. And I sometimes call these the four economic horsemen of the apocalypse, and there are only four at the moment. I've gone a bit too fast there. Four horsemen of the apocalypse, and I'm quite keen to retain that analogy, even though there have been candidates for other shocks. 3 years ago, of course, in the UK we had Liz Truss was briefly Prime Minister, and Kwasi Kwarteng next to her there was Chancellor, and that was a major but short-lived economic shock. So it didn't quite qualify as another horseman because it was a bit too short, but that was certainly something that impacted quite heavily. This is a better candidate, which is Donald Trump here on Liberation Day, April 2nd this year, announcing his tariffs. And people I think were more worried about the impact of the tariffs on the global economy than it has turned out to be the case. But certainly, if you have a president who is giving us the biggest U.S. tariffs, the highest U.S. tariffs since the Great Depression, and U.S. tariffs and the trade wars of the 1930s are widely blamed for at least extending the length of the Great Depression in that era. So people who were right to be worried about tariffs, right to be worried about their impact on world trade. But these things don't happen in isolation. And what we've seen in America as well is that the U.S. economy has also slowed down as a result of the tariffs, as a result of other uncertainty created by this particular presidency. So what we've seen is a sharp slowdown in employment growth in America. The economy seems to be growing okay at the moment. It slipped a little in the first quarter of the year when lots of businesses were importing into America to try and beat the tariffs. But the economy is growing okay, but employment growth has certainly slowed very sharply. Some of this is due to Elon Musk and the Department of Government Efficiency. A lot of it is due to just the fact that some of it may be due to AI and the replacement of workers, but in general, it's due to a lack of confidence among American employers. So U.S. employment growth, which was very strong, as you can see, has slowed quite sharply, and in certain months this year has gone negative. I think after one of those negative months, Donald Trump sacked the statistician in charge of these figures. But even so, that doesn't seem to have corrected the problem that U.S. employment growth is still very weak. And fortunately, in response to this, we've seen, the most important interest rate in the world, as I'm sure you know, is the one set by the Federal Reserve, America's central bank. And there's been a battle between the White House, between Donald Trump and between Jerome Powell, the head of the Federal Reserve, over whether interest rates could be cut. Powell has been worried about the inflationary impact of tariffs. If you impose taxes on imports, then you're likely to get higher inflation. But I think what has tipped the balance is something that Trump would not want, which is the weakness of employment, the weakness of those jobs figures. And so the Fed has now cut interest rates twice. That I think is responsible for lots of things you see around the world at the moment. People sometimes ask why, in the wake of tariffs, stock markets are quite as strong as they are, and that is entirely, I think, an interest rate story. When you've got the Fed cutting interest rates, which sets the tone for other central banks to be able to cut interest rates as well, that explains why the stock markets are being so strong, and why, in general, this does not feel like a recessionary world at the moment. Certainly not a depressionary world. And you see that in forecasts. People are joining this call from all over the world, I gather, but you see the picture there of, this is from the International Monetary Fund, of pretty reasonable global economic growth, about 3% a year. In good times, you'd expect the world economy to be growing by 4% a year. So we're, if I may use in this electric vehicle age, an internal combustion engine analogy, we're probably firing on only 3 cylinders out of 4. But even so, there's growth pretty well everywhere. The old rule was 2% growth in the advanced economies, 6% in the emerging economies. We're a little bit below that in both cases, but there's growth everywhere, and those Federal Reserve interest rate cuts certainly help that process along. So we're looking at a continued growth in the world economy, and as I say, pretty much everywhere. The tariffs have not done the damage that was feared. So I think that is, in general, good news. If we look at the closer to home in the UK, some people will be interested in this, some people won't. But I think the big story of the budget yesterday was that we've had the blue bars there are the new forecasts from the official forecast of the OBR, Office of Budget Responsibility. And as you may also know, there was a major leak of its forecast just ahead of the Chancellor making her statement. But most of those bars, the blue bars, are less than they were just back in March. So there's been a downward revision of growth forecasts an upward revision for this year, downward revision in future years. And this is a continuation of the story of the UK economy for the last 15, 17 years of much slower growth than we've been used to in the past. So, pre financial crisis, we were used to much stronger economic growth. Just to give you a statistic on that, when I mentioned Liz Truss just now, who was briefly prime minister, when she was prime minister, she said her ambition was to lift UK economic growth to 2.5% a year. 2.5% a year is exactly what the UK economy has grown on average since 1945. But that's split into 2.8% a year until the financial crisis, just over 1% a year since. And we still seem to be stuck in that just over 1% range at the moment. Nothing seems to be changing very much on growth. It's still quite modest. And the big reason for that is that productivity, which is an obsession among economists and economic writers, it's the amount we get out for what we put in. So it's measured by, GDP, gross domestic product per hour worked or per person employed. If just looking over the next few years, if it had grown in line, if it was to grow in line with its pre-financial crisis trend, then we'd be doing a lot better. And the tax increases that were announced yesterday would not have been necessary. But as it is, it's growing much more modestly than that. It's barely growing at all. And that's why, Rachel Reeves was obliged to raise taxes to keep the public finances on track. And it's very important. Anybody who wants to talk about that, please ask me about it. But I'll move on to the budget now quite quickly. And just to put this, one of the things that I don't know anybody's here from America, but one of the surprises, if you look at this chart, is that how strong U.S. economic growth has been in recent years. Most of that, of course, under Joe Biden. This compares pre-pandemic levels of GDP with where we are now. And that didn't do the Democrats any good at all in the election we had a year ago because cost of living pressures were more important to voters. And, increases in gasoline prices, in other prices were more important than the fact that economic growth had been pretty strong. The UK is down there, pretty near the bottom there. So if we want to get near the top of that league, which was one of the ambitions of this government, then there's quite a long way to go. What about the budget itself? The central story of this was that a chancellor who said a year ago that she wasn't going to raise taxes has had to do so again. And the ground was prepared for this even before the leak of the official forecast 45 minutes before she stood up. But let me just go through briefly what the story of this budget was. So we're getting higher public spending. Quite a lot of that spending is on welfare. Almost alone among major economies, the UK has been battered by the pandemic and the effect of the pandemic on long-term sickness. So we look at the numbers of people who are economically inactive, of working age but out of work and not available for work because of long-term sickness. It's gone up a lot in the last few years in the UK. It was 2 million before the pandemic. It's 2.8 million now. And nothing that governments seem to be able to do can solve that problem or solve the problem of expensive things like the triple lock on pensions, guaranteeing that pensions will rise in line with inflation, average earnings, or 2.5%, whichever is the highest. So welfare spending is going up at all. The good news, I suppose, on tax is that most of the increases in tax that we saw announced yesterday, which I think were not as bad as people expected, will come later. So a lot of these are towards the end of the decade, 2028, 2029. So there is time for a rethink of most of these things if economic circumstances were to turn out better than expected. It's a delayed tax budget. And I think that is, compared with fears just a couple of weeks ago that income tax was going to go up immediately, I think that is quite a positive thing. Amid generally, nobody likes to see taxes going up. Taxes are going up quite a lot again, but it's a delayed tax hike that we're seeing in the budget. The main numbers, this is from the Office of Budget Responsibility, that we are going to see extra spending, and most of that welfare spending. The government has been forced to U-turn on a couple of things on welfare. It's raising taxes by a total of 26 billion, and most of that comes through the additional freezing of personal tax thresholds and allowances, together with smaller measures, and there will be more borrowing in the short term, but less in the longer term. So this is a delayed action budget, as I say. Tax rises, you know, again, what we're seeing here, and it was part of the understanding that the governments had with voters that tax thresholds and allowances should increase in line with inflation every year, every April in the UK. That was legislated for in the 1970s, something called the Rooker-Wise Amendment, and was broken by the Conservatives when Rishi Sunak, who is now a colleague of mine as a columnist on the Sunday Times, was Chancellor. He decided to freeze it to try and bring back the public finances after the huge amounts of expenditure that were incurred during the pandemic. But that has now been extended, so this legislation that was, I say, passed 50 years ago and was honoured until the early 2020s has been broken, and it is now debatable about whether we'll ever return to that policy of operating these allowances and thresholds in line with inflation. And then we've got other taxes, some of which I'll come on to, which do affect the property sector, also gambling, also introducing for the first time some taxation on electric vehicles to make up the gap as people switch from petrol and diesel to electric. So that's the big picture, and that gives us for the UK a record tax burden. Now, sometimes people think of this as a bit of a puzzle because we've got figures going back to 1947 on the tax burden. Of course, it was higher during wartime, but this is now the highest peacetime tax burden that we've ever seen in the UK. And people are a bit puzzled by that because, those of you with longer memories will remember that we once had a 83% top rate of tax. We had higher taxes in general in the past. And taxes on ordinary working people are actually quite low at the moment because the previous government cut one of those taxes, national insurance. But the overall tax burden spread around an enormous number of taxes, we've got a very complicated tax system, is the highest it's ever been and is moving higher. So this adds up to a record tax burden. A lot of that was due to the previous government, but and the announcements it made, but quite a bit of it is also due to this government. And so we're seeing that. And, we're seeing also, that living standards are not going to rise very much over the next few years. People won't see living standards falling, but they won't see them rising by very much. So the period we've been in for quite a long time now, where people don't feel much better off than they have done. And just to give you a figure on that, one of the ways you might measure that is by taking GDP, broadest measure of economic activity, and dividing it by population, GDP per head. GDP per head since the financial crisis has risen by about 6% cumulatively in total. And over the previous 16, 17 years, it rose by 46%. So we're in a period in which, living standards have been squeezed. People don't feel as well off. And that explains, I think, helps to explain the rise of fringe parties, what were previously fringe parties, coming into the political mainstream and leading in the polls, because people just feel squeezed and miserable. They feel that things aren't working and that things could be a lot better than they are. And, markets reacted quite well to the budget we had yesterday, but, they're still slightly on edge, still slightly tense in terms of what might happen to the government borrowing and the public debt in future. So we're still not out of the woods in terms of the public finances. UK gilt yields, 10-year gilt yields are still the highest among advanced economies, and will still the highest even after a favourable response to the budget that we saw yesterday. So still work to be done, I think, to convince markets that the government has got to grips with these things. Now, what about I want to talk about property in the budget. And one thing I would say is that compared with what was feared ahead of the budget, among the things that were feared ahead of the budget were that landlords would face national insurance. National insurance is levied at 8% rather than this smaller increase. And the other thing, which was completely mad, but was quite well flagged, including on the front page of one of the papers I write for, the Times, was the idea that capital gains tax would be applied on main residences. So for the first time above a certain level. Neither of those things happened, but as you can see here, there is additional taxation on property. Landlords will face a 2p increase in income tax as a result of that. At one stage, this two percentage point increase in income tax in all rates of income tax, so 20% basic rate goes up to 22%, the 40% rate goes up to 42%, the additional rate goes up to 47%. At one stage, that was feared that would be a general increase for everybody. That it's only for these groups, and as I say, it's there, but it's smaller than was feared. It could have been worse. The other one, which I think is a bit of a nightmare, is this idea of a high value council tax surcharge, which will begin at 2,500 a year for homes just over 2 million, valued at just over 2 million, and then rising up to a maximum of 7,500 a year. It's again more modest than was feared. It's not, people feared 1% of property value and things of that order. This is quite a small, if you're thinking of a mansion tax, this is quite small in relation to what might have been. So I think that Mark will have views on this as well, but I think the property sector got off more likely than it might have feared. There will be an enormous amount of debate. Again, this is something that's not coming in for a few years. An enormous amount of debate about whether a property is worth 1.95 million or 2.05 million as this is introduced, and it won't raise all that much revenue. So don't be surprised if there are further amendments along the way to this tax change. Landlords have been hit again, and I think they can feel that successive governments have got it in for them, particularly smaller landlords. So smaller landlords are already complaining about, that they're losing out to institutional landlords in the UK private rented sector. But again, as I say, it is smaller than it might have been, and but it's also smaller than the many hits that the private landlords have taken over the past few years. So I wouldn't dismiss this, but I would say it's also not as bad as feared. And we know from, and this is the Residential Landlords Association, we know that if you increase taxes on landlords, you will most probably see it feed through to higher rents, because that money has to be clawed back somewhere. And this is what the NRLA is saying, that at a time when we need more homes to rent, is this a sensible thing to do? But I think this is, I think they're slightly going through the motions here, because again, I think they would have feared something worse in the budget. Is that mansion tax going to be workable? Rightmove, the residential estate agents think it will open up a series of tricks that people get up to try and avoid this. But as I say, it's not a fortune. It's not I don't think it's going to. If you can afford a £5 million property, I don't think the idea of paying a relatively small amount of additional council tax is really going to deter you. And I don't think it will have as much of an impact on the market as Rightmove fear here. But as I say, people have to respond to this. What else did the budget say? This is a forecast from the OBR about future property taxations, and as you can see here, the yellow line is what they expected in March. The blue line is what they expect now, and I don't think this is a reflection of the tax changes in the budget, but more the fact that they've revised down the growth of living standards, and they think that will feed through to there being less appetite among private buyers for in the property market. I don't think this is a seen as a kind of tax increase is necessarily killing the market. It's just more of a general economic effect they're seeing there. And as you may know, the present government has a target of adding 1.5 million new homes by the end of the parliament just in England. This is a UK figure here. And it shows that although we eventually get to 300,000 net additions by the end of the decade, you're not there for most of this decade. So you end up, well short of 1.5 million new homes, even for the UK. And of course, the English figure is smaller than the UK wide figure. So I think this figure of this target was always asking a huge amount. I didn't think it would ever be achieved, and I think the budget and the new forecast has confirmed it won't be achieved. So we're still looking at, if you're looking at the UK market, UK housing market, we're still looking at shortages. We're still looking at a lot of tenant demand. We're still looking at a market in which not enough new homes are being supplied. So plenty of demand out there for landlords, despite the small irritations of a bit of extra tax and so on. Finally, what about interest rates? I'm channeling Sherlock Holmes here. The dog that didn't bark. This is the dog that does bark quite a lot. Not my dog, by the way. But what does all this mean for UK interest rates? We've now seen, I always say to people, if we were talking here 4 years ago, back in 2021, we would not really have anticipated what was going to happen to interest rates over the next few years. Because back in 2021, the Bank of England was putting the idea of negative interest rates, a negative official interest rate, a negative bank rate into its toolkit. So we could have had a bank rate below zero, but instead of which, at the end of that year, 2021, it started raising interest rates and then didn't stop raising them until they were more than 5%. So we moved decisively out of this period of near zero interest rates into something more like the pre-financial crisis norm. Then they've come down a bit, five quarter point cuts, 5 25 basis point cuts. And it looks as though we are heading for further rate cuts. There was nothing in the budget to prevent the Bank of England cutting rates further. And there was a certain amount in what was announced to encourage them to do so. Inflation is still a little bit above target. We still have, as well as the highest gilt yields, highest bond yields, we still have the highest inflation among major economies. And as you can see here, UK inflation is higher than for most other countries, even for the US, despite the tariff effect. Some countries have got very low inflation at the moment. Eurozone inflation is roughly 2%. UK inflation is more than 3.5%. But I think, and in particular, you look at things like food price inflation, around about 5%. Important because food price inflation conditions people's attitude to inflation. This is a regular purchase that people make. Food prices are going up a lot. You notice that and you think all inflation must be about 5%. So it's very important for inflation expectations. But I think even there, we're expecting to see a downturn in inflation in coming months. We're never going to go back to that period of near zero interest rates, even though the Bank of England has the capacity to reduce interest rates to there or even lower than that, because I think central banks collectively regard that as an aberration now, regard that as something of a mistake to do that. But I do think we're going to somewhat lower interest rates. That central banks have this idea. What's our normal interest rate? What kind of interest rate do we need? What kind of equilibrium rate do we need? To keep inflation at target, and it's lower than it is now. So I think we will see another cut in rates in about 3 weeks' time from the Bank of England, and to 3.75%, 3.75, and I think there will be a couple of further cuts next year. So we are heading lower for interest rates, and the inflation should come down, and that will support the idea, and that will support the housing market, will support the economy more generally, I think. So that is that is in prospect. There is plenty to think about, and I hope you've got plenty to ask me about and to ask Mark about in the next few minutes. We have to hope there's not going to be too many more of these shocks, these what became known as black swans during the global financial crisis. I can tell you that these are actually real black swans, genuine black swans. That if you're ever in England, if you're ever in Kent, you can see these black swans. They are the descendants of black swans that were gifted to Winston Churchill in the 1920s, and they're at his former home of Chartwell in Kent. So those black swans are fine, although they do peck a bit. But we don't see one of those any more of these financial black swans. And finally, before we move on to questions, I've given you a lot of economic indicators, probably more than is decent at this time in the morning. But I always come back to my own proprietary economic indicator, which is known as the skip index. Skips have different names in different countries, but they are the things that you put building rubbish in when you're having work done. And I've been monitoring the skip index for many years. It's based on the number of builder skips in my street. And it's the way it works is that when there are none at all, there's no growth or in recession. I originally developed as a housing market indicator because on the basis that the moment that somebody buys a house, the first thing they do is rip out the kitchen, and you need a skip for that. But then I realized that you could develop it into a general economic indicator. That are not at all, we're in recession or there's no growth. If there are two, we're growing in line with what economists have called trend growth. And if there are four, it's an unsustainable boom. And I can tell you that during the pandemic played havoc with the index because when COVID-19 first broke, nobody wanted a builder anywhere near their house, so there are no skips in the street, and things looked very bleak indeed. And that was the time when GDP collapsed as a result of COVID. Then quite quickly, everybody decided they were going to be working from home forever, so they wanted an office built in the loft or in the garden. So there were many skips in the street, and that was a harbinger of the inflation we were about to see. And then, but things have settled down now. We're not quite, so there's a bit of growth in the economy. There's one skip in the street, I can tell you. So things aren't exactly all right with the world, but their growth is just about hanging on. We're not in recession. There's a little bit of activity there, and a little bit of activity in the housing market because that particular skip has been hired because somebody has just moved into one of the houses in the street. So things are just about holding on. Things are not as bad as they might seem from some of the headlines you'll have seen about the UK budget, and I don't think they're as bad for the property market either. So let me end there. We'll go to another slide, I hope, and thank you very much for listening.
Thanks, David. That was really helpful. So I think we do have some questions, and I've got some from before. So one interesting thing that was in the budget yesterday, and you did touch on, is the OBR are suggesting household income and GDP will drop, productivity will be down. So what does that help in terms of pushing the Bank of England to reduce interest rates anymore?
Well, if you think about it, I mentioned the Federal Reserve, American Central Bank, which has what is known in the jargon as a dual mandate, that it has to look at employment as well as inflation. The Bank of England is supposedly focused just on inflation, but it does look at what's happening in terms of growth, and it is certainly the case that if you have slow growth, then what happens is, in technical terms, there is a buildup of slack or spare capacity in the economy. And one measure of spare capacity, of course, is unemployment, and that reduces inflationary pressures and makes the bank more likely to cut interest rates than otherwise. In general, if the economy is growing fine, if it's growing strongly, you're more likely to get interest rates not being cut or being raised.
Yeah.
In a slow growth environment, you're much more likely to get them being cut. So definitely that is the case. It helps that process along. Yeah.
So actually, that is good news for landlords if rates do cut. And to be fair, all the forecasts earlier in the year that we were going to see a couple of cuts before Christmas, I don't think that's going to come now. But I think hopefully into the new year that's good. But as you said, I mean, I definitely read it that it could have been so much worse. You mentioned everything else. The one you didn't mention is stamp duty, land tax, which they were talking about increasing for some and reducing for first-time buyers. They didn't even touch that, which is really interesting, given the fact the Conservatives were talking about if they get in wiping stamp duty, but at least that's not as bad. So I don't think the taxes were that bad. One question a few people have asked is, Have you had any indication from anybody you've spoken to when the higher rate mansion tax bans are actually going to come in and who's going to pay them?
Yeah, the idea, as I said, most of these things are delayed for a few years. That is supposed to come in 2028. So just going
Okay.
back on your stamp duty point, I think it was an interesting one that the holy grail of property tax in the that people don't like stamp duty. It's regarded as one of the worst taxes you can have because it stops mobility, stops people from moving. It's a tax that is levied at the worst time for buyers. When they've got so many additional expenses, it does put a brake on property transactions. So the
Yeah.
holy grail has been that these that you replace both stamp duty and council tax with an annual property tax. And so the the higher the so-called mansion tax, the council tax premium that was announced yesterday, is a kind of a small nod in the direction of a property tax, a proper property tax, but was not the tax reform that everybody thinks is necessary. So
No.
if you and the what has stopped them, I think, and what is going to be the problem, the issue with this council tax premium, and what 10 years ago when Ed Miliband, who's still in government but is no longer the Labour leader, when he was Labour leader, that he proposed a full-blown mansion tax, which would be levied as a percentage of a property value, and and the problem there, and the problem with this one may be people who are asset rich but income poor. So
Yeah. Older
you may have,
people,
sorry.
older people, retired
Well, you
people are
may,
going to
yeah,
get really
exactly.
hit with this.
You might have a couple of teachers who bought a property in a part of London that was unfashionable in the 1970s, but is highly fashionable now. And
Yeah.
they're living in a £3 million house that they bought for a few tens of thousands. And they couldn't afford to pay 1% of that property's value. And there
No.
are ways around that. Deferring it, and the way this has been set up, there will be the opportunity for deferral, so it can be
Yeah.
part of somebody's estate rather than paid immediately. But 2028 is when this is all supposed to come in, so there's a bit of time to do it. The argument, the Treasury argues that we're quite, despite the reluctance to revalue properties for council tax, they haven't been revalued since 1991 when council tax was introduced. There is now, a proper and quite agreed way of valuing them. We've got the online estate agents. We've got, there is a lot of information out there, which should make it easier than it was back then. You don't any longer have to send an inspector around to inspect every individual property. You can do, you know a lot more about this than I do, Mark. But
I think it's going to be interesting. The devil will be in the detail. As you say, they've got 3 years to talk about this and change their mind and remove it and be worried they're going to my prediction is they will get very worried about re-election because they'll have a year left before they're booted, and they'll be worried about how many older people will get hit by this and generally how bad the market is. So I'm not sure this will come in. But let's keep moving. I mean, one of the interesting things in about this is that the 2%, apart from the 2% that's coming on landlord's tax, actually the mansion tax doesn't affect the bread and butter market. So properties below £2 million. And today we've got people from 60 countries on this call. Hopefully everybody understands English because my Chinese, Hindi, Arabic is not great and I won't be speaking it. But we've got people from all over. So a lot of our clients are overseas people. And I think the interesting thing is that this doesn't affect the bread and butter part of the market. And if with productivity reducing and interest rates come down, house prices will rise. Don't you think, David?
yeah, I do. And there is almost a kind of a perfect economic relationship between lower interest rates and rising house prices. And the past few years has seen a real roller coaster when it comes to UK house prices because everybody thought the onset of the pandemic that house prices would fall. In fact, we saw a pandemic boom in house prices because people had time, people had different preferences in terms of where they wanted to live, and so on, and all that is starting to settle down now. Things like working from home changed
Yeah.
the way people thought about where they wanted to live and so on. But there is, I think house prices will go up. And the other thing, we should mention in the context of interest rates is, what is very important is what happens to bond yields, which are the driver of fixed rate mortgage rates.
Yeah.
And I think the most reassuring thing that we had yesterday among all the numbers was that gilt yields fell on the day. Markets are a bit more reassured for now that
Yeah.
the UK has been in a permanent fiscal crisis since this government took office in July last year, and the sense that by giving herself a bit more room for manoeuvre, by announcing these tax changes, but they won't come in for a while, that the markets will lay off the government a bit. They will, and that gives the opportunity, along with lower bank rates, for interest rates to come down, and that will feed through to lower mortgage rates for landlords and for individuals. So I think that is good news. The house prices,
Where
UK,
do you think they're going to be, David? Do you think we're going to see 2, 3, 5, 10 next year? What's your prediction?
in terms of house price rises.
Yeah.
Yeah, I don't think it'll be 10. I think it'll be 4 to 5. I would have thought. Yeah, something like that.
Good. 4 to 5
Yeah,
is good with inflation at 3, 3.5, give positive
yeah,
cash flow. So one thing
yeah.
that hasn't been addressed in this, and clients, a large number of our clients own properties in offshore structures, so offshore companies. If you do, the additional 2% doesn't affect you because it's only on personal taxes because I think there was an awful lot of debate going on and pressure from large BTR funds on not taxing them on corporation tax. So if you own it in an offshore structure, you will pay the same corporation tax in the UK, which is 25%. And then when you extract the dividend offshore, there's nothing extra. So for overseas people who owned it in an offshore company, there's no worry. One other thing that someone did ask, which is quite interesting, you talked about Donald Trump and you talked about the US, and we've heard an awful lot about Donald Dashers, people coming from the US and buying in the UK. And while we have a number of US owners, do you think it's good for a US citizen to buy, something in London now?
It's an interesting one because there are two things happening at the moment. We one is the exodus of certain people, non-domicile people in particular,
Yeah,
because of the changes in the rules there. And I'm sure you're experiencing some of that, Mark, in your business.
yeah,
And that is because and some people on the call maybe be direct victims of this, is that it was always the case. The non-dom rules were going to be tightened, but the idea that you could impose inheritance tax on worldwide assets of non-doms was always to me crazy. I mean, if you're a rich international business owner, you were never going to want all your assets to come under the UK inheritance tax regime. So I think that was crazy. But there is another side of the coin, as you mentioned, and that is some quite highly publicized American buyers in the UK. Not just in London. The Cotswolds seems to part of the Cotswolds seem to become
yeah,
where JD Vance took a holiday, and some very high
yeah,
high profile
yeah,
American buyers in there as well. So I think it is interesting that the UK. And we used to talk a lot about what is the UK's appeal for foreign investors, and a lot of it was familiarity. The English language. People like the fact that they're familiar with the culture, via TV and everything else, and they're familiar with the language, and they like the UK. So and I think the UK still has enormous appeal there. So
yeah,
and I remember this a few years ago when many of the hedge fund people absconded to Geneva, and a lot of them I talked to if it wasn't them that were missing London and the UK, it was certainly their wives were missing it a hell of a lot, you know.
Yeah.
So I think, but so I think there is inward as well as outward there. So and I
I
think that's
think there will
positive.
definitely be more inward. I mean, and I think a lot of people need to be be very clear on the changes that we've seen in the budget. Look, neither of the changes. The mansion tax affects properties above £2 million. Now, let's bear in mind that that is high value property. If the rent is over £100,000 a year, it does not fall within the Renters' Rights Bill, which is this new bill, which I've done webinars on, which I hope all of you have joined. I will do another one coming up. But it doesn't, if the rent is over £100,000, it does not get affected. Most of the properties, maybe not at two, but above 2.5 million, the rent will be above £100,000 a year. If they do, then this £2,500 charge will just apply straight, or 3,500 or 7.5 will just apply straight to the tenants. So we don't, that's something you shouldn't worry about. Is that the 2% landlord's tax? It only applies to people, i.e., individuals. It does not apply to offshore or UK companies. So, bearing those things in mind, this is not going to make everybody run for the hills, which is why, the budget sterling has stayed very strong, and hasn't changed. The interest rate hardly, the exchange rate hardly changed yesterday. The stock market's positive this morning. Gilts, as you say, are still okay. It's on the fence, but it is not going to make people run for the hills. What it
No.
is doing is it makes new entrants. It's another couple of reasons. It's death by a thousand cuts, but still am not convinced by the time 2028 comes around whether they will backtrack on some of this. So we live it. Let's ask some other stuff.
I
So
was just on that, Mark. I
oh,
mean, I agree very much, and I think what you have to bear in mind is, and what your uh, clients and people on this call have to bear in mind is that there was a lot of talk pre-budget about a wealth tax, and pressure from within the Labour Party, the governing party, for a wealth tax, and pressure from former fringe parties like the Greens for a wealth tax, and so there had to be a nod in the direction of taxing richer people more. But this is the smallest nod you could make. This council tax premium for high value properties is really just the merest wink as opposed to a nod. So I think it was. I agree with you entirely. This is not something that should deter people from the UK market.
no, I agree, and I think it's interesting. So a couple of people have asked about what changes it makes to inheritance tax, and non-dom rich people. You did mention the non-dom status. Do you want to just tap on those two just quickly? On inheritance tax, nothing has changed. It's the same, but it's the same. It's £325,000 of net assets per person. Non-dom status, David, maybe we want to give a quick recap on it.
Yeah, essentially, non-doms has been a target for the Labour Party, the governing party, for some time, and the previous government, Conservatives, reduced its scope considerably, and now the status has been removed entirely. Now people can still pay an annual fee instead of the full charge. But I think the killer thing with non-dom status is which I'm surprised the government has not revisited, is this inheritance tax liability on worldwide assets. If for example, I won't mention any names, extremely rich Indian billionaire has to pay inheritance tax on assets all around the world, including many of those in India. They're not going to stay in the UK, so they go somewhere else. And I think that is why we've seen a something of a non-dom exodus, but not as much as you might have feared. I think some people have decided to stay here for the reasons I said. There was something I've not quite got my head around it yet, but there was something on inheritance tax which slightly sweetened the pill for farmers and so on. But I'm not into the detail of that. There was a lot to digest in a budget, but I don't think that matters particularly for our listeners this morning. But
No, sure. And so where I think a lot of people are worried about if this is going to tinker and stop and affect the market. As I said, I don't really feel this would affect anybody who already owns Running for the Hills. As I think the same with the Renters' Rights Bill. These two pieces of the legislation they brought in and the budget is not going to make everybody exit.
Yeah,
I think you're all right. It's more difficult for entrants. But the reality is, why do people buy London property? I mean, my view is it's a fixed asset. It is liquid, so you can exit even in challenging times. It is very stable. As David said, from COVID, house prices have increased. Rents have increased exponentially since COVID. They didn't do so much this year, but you saw big increases. Your yield is there. Your finance is in place. Yes, you have to pay stamp duty, but it is a good wealth store. And I think that is why people honestly buy London property. Yes, everybody's reading Dubai is off the hook, and Dubai is really off the hook, and we are selling if anybody's interested. But the reality is Dubai is a unstable market. We saw the boom and the bust before. There may not be a bust this time because it's much more robust, but it is not like London.
yeah. I
London
mean,
is
one, yeah,
London will always be London. So, David, what's your thought on that?
yeah. And one of the things about London, as people, there's a lot of talk at the moment about, stock market, whether it's an AI bubble, and some people worry about housing market bubbles. But and you will confirm this, I'm sure, Mark, that compared with some other regional cities in the UK, London has not been going gangbusters in recent years. It's there have been issues there for the London market to do with very high and punitive levels of stamp duty and so on, which have cooled the market in London. So you're not buying into a very toppy market in London at the moment.
No,
It's as you say, it's a stable market, and it's not one that people should be fearful that you're going to be the one left holding the baby, because I
no,
don't think it is that, and it's
100% not.
yeah,
I mean, I think this is honestly the number of people I speak to, if they call me and tell me they want to exit, when I've spoken to them, so many people are interested in buying. This is a buyer's market right now. So whether you're from the US, Hong Kong, Singapore, KL, China, the Middle East, London is on sale at the moment because
yeah,
of the taxes we've had. Yes, you can still exit, but you can buy incredibly good deals. There's lots of stock coming on. There's massively shortage of supply still for tenants. So rental market is very strong. So this is really the time to be buying. And if the forecast is correct and interest rates, productivity goes down, so interest rates go up, and we see even a modicum 4% house price growth next year, that wipes out inflation, pays down your mortgage, and I still maintain the reasons you'd invest in London will continue. Um,
yeah.
one question: do you know when someone's asked when the increase in income tax is going to come in? Is that 2028 as well?
Yeah, I mean it's a very good question, because it is here now. Just to explain this, the this increase in income tax is a stealthy increase in income tax, in the sense that people are being it's fiscal drag. People are being dragged into paying more income tax, paying higher rates of income tax, because the the income tax thresholds and allowances are not being increased in line with inflation. Now that process began in 2022, so it's here now. It was due to end in 2028, and it's been extended for another 3 years by the Chancellor yesterday. So this was going to be almost a decade in which, in real terms, those income tax allowances and thresholds are falling, because they're not being uprated in line with
I meant
inflation.
the
So
additional 2%, David. When do you think
oh,
that will
sorry,
come
that one.
in?
Yeah. I think that is. Oh, sorry. That's a very good question. I think that is due to come in April next year. Yeah. That is my.
From April next year.
I believe so. Yeah. Yeah. Yeah.
Okay,
Yeah.
so it's not clear.
Yeah.
Another
No, I
question.
can. I can tell
Another
you the
question.
answer to that.
Go on.
Yeah.
Sorry. I
No.
think
Go.
this
Go
is a
on.
good go on. This is a good question, and I think it's quite interesting. Is around the buy to let and the build to rent market. So build to rent are large corporates, US funds, China funds, Singapore government. These large funds investing into UK assets which are rented out, build to rent. So what do you think on that market? Do you think that's going to continue to grow? And if you do think it's going to continue to grow, is that going to push out SME, small smaller landlords?
I think it's a very good point. I mean, it's surprising that this has taken so long because for these institutions, build to rent provides the kind of long-term stream of stable income that they need. They need for their liabilities. So whether it's pension funds, insurance companies, and so on. So this is almost a no-brainer for them. I think there are different markets here. Landlords, smaller landlords often have just a few properties, sometimes a single property, and have much better in many cases long-term relationships with their tenants.
Yeah,
There are a lot of the individual landlords I know and come across have had the same tenants for 20 years. They
yeah,
are, and whereas I think the institutional ones, it's not quite the same as
it's
student
not.
accommodation, but it's one where there's an expectation that turnover will be quite a bit more than that. Individual landlords prefer not to have turnover because it's expensive, it's
Yeah.
disruptive. You often have times when you miss out on a month or two of rent because of that. But institutional landlords build that into their plans, and I think it's a different kind of relationship. It's a slightly different sort of market, in my view. So I think there's room for both. There's no doubt that all the things that you've mentioned, Mark, have reduced the appetite for new entrants, but not entirely. There are
Oh.
still plenty of young people who want to get into being landlord, want to be landlords. And they see it as a lifestyle choice, a business choice. It's something that
100%. No,
appeals to
well,
them.
look at the pension change, right? They're going to cap the amount you can do salary sacrifice. Is
Yeah,
that a reason that's going to push UK investors, looking at the beginning into property investments? I actually think it might,
yeah.
because
Well,
if
it's
you look
interesting.
at
But
salary,
yeah, I always look at in the Sunday Times on the back of our money section. We always have a thing where we talk to minor and major celebrities about their personal finances, and one of the questions that's always asked is property or pension. And I would say that 90% of the time they say property. So it's they regard property as the best pension you can have and the best way of preserving an income into retirement. So I think that still stands. And as you say, in London, you can't really go wrong on that basis.
no, it's good. Right, David, we are at 11 o'clock, and I'm going to thank you so much for joining us and giving us those insightful recap on the budget. No, was it a war on landlords? Honestly, it wasn't a war on landlords. Does it kill off landlords in the UK? No, I don't think it does. Personally, I will be looking this year, next year, 2026. I'm personally going to be looking to buy because I think there will be some serious deals next year out there for those people that don't listen to our advice or our webinars and think this is the time to rush out of the London market. So I think that's the time to take advantage. I think this is the year coming that you can do very well. Yields will still be high. I think those forecasts they're doing on government building on the number of new homes that are going to be built are still ridiculously high. They won't get anywhere near these targets. And so therefore, I think we're going to continue to see a shortage of supply. So I think it's a good time to buy. If you need any help or got additional questions, I think we answered most. But if you have any more, you can email us webinar@benhams.com or mark@benhams.com is my email, and I can pass them on to David. There will be a recording of this webinar on our website. It will go live, and everybody on the call should receive an email with it if you want it. But thank you so much for joining us today, everybody. And David, thank you very much indeed.
Thank you.